Have you ever heard someone say, "I invested for years, but I barely made any money"? Here's the surprising truth. Most investors earn less than the market average. Not a little less. Often a lot less. And it's not because they're lazy, unintelligent, or unlucky. In this video, I'll explain why most investors underperform the market in plain English, and more importantly, how you can avoid making the same mistakes as a beginner investor. No complicated math. No stock picking hype. Just simple ideas that actually matter. What the market even means. Before we go further, let's clear something up. When people say the market, they usually mean something like the S&P 500 or a broad stock index that represents many companies. Think of it as the average performance of hundreds of businesses combined. Historically, this average has grown steadily over long periods of time. So when we say most investors underperform the market, we mean most people earn less than what they could have earned by simply owning everything and doing almost nothing. That's the key idea. Mistake number 1, trying to beat the market. The number one reason investors underperform is simple. They try to outsmart the market. They pick individual stocks, chase the next big thing, follow hot tips from social media or friends. Here's the problem. The market already includes professional investors, hedge funds, analysts with teams, data, and decades of experience. When you try to beat the market, you're competing against all of them. That's like joining a professional race when you just learned how to jog. Most people don't realize doing less often earns more. Mistake 2, emotional investing. The market goes up and down. But humans panic. When prices fall, many investors think, I should sell before it gets worse. When prices rise, they think, I need to buy now before I miss out. This leads to a terrible cycle. Buying high, selling low, which is the exact opposite of what you want. The market doesn't punish lack of intelligence. It punishes emotional decisions. Mistake number 3, constant buying and selling. Another big reason investors underperform is overtrading. They Check their investments every day. Make frequent changes. Jump in and out of positions. Each trade comes with fees, bad timing decisions. Ironically, studies have shown that investors who trade less often usually earn more. Why? Because the market rewards patience, not activity. Doing nothing feels unproductive, but in investing, it's often the smartest move. Mistake 4, chasing performance. Many beginners invest by looking backward. They ask, what did well last year? What's everyone talking about right now? So they pile into whatever just went up. But by the time something is popular, most of the gains have already happened. What goes up quickly often slows down or falls later. The market doesn't reward trend chasing. It rewards long-term ownership of solid businesses. Mistake number 5, lack of a simple plan. Most underperforming investors don't actually have a plan. They don't know why they're investing, how long they'll stay invested, what they'll do when the market drops. Without a plan, fear controls decisions. Headlines control behavior. Emotions control timing. A simple plan beats a complicated strategy almost every time. How beginner investors can do better. Here's the good news. You don't need to be special to outperform most investors. You just need to avoid common mistakes. Simple principles. Own the whole market instead of trying to beat it. Invest consistently over time. Ignore short-term noise. Stay invested during ups and downs. Costs low. Be patient. The goal isn't to be brilliant. The goal is to be disciplined. Final thoughts. Most investors underperform the market because they act like investors instead of owners. The market rewards time, patience, simplicity. If you can master those 3 things, you're already ahead of most people. If this video helped you understand investing a little better, consider liking and subscribing. And remember, in investing, boring usually wins.